The team at Technology for Hotels knows how busy you are, so we've created this concise briefing to keep you up to date on key happenings in the hotel industry. Let's dive in.
Welcome to the 5-Star Weekly Briefing, your pulse on the hospitality industry.
This week's briefing is brought to you by GAIN, a global network of C-level experts providing strategic advisory and commercialization services to hotel groups and hospitality tech innovators.
It is Friday, the 27th of February, 2026. And I have to say, just looking at the stack of reports we're doing a deep dive into today, there is a very distinct narrative thread running through everything.
Yeah, there really is. It jumps right off the page, doesn't it? From construction delays down in Melbourne to these massive price tags on renovations up in Sydney, the industry seems to be taking this collective breath.
Exactly. We are seeing a market that's being forced into a quality over quantity mindset. And I don't think this is necessarily coming from a place of, artistic vision. It feels like pure economic necessity at this point.
Right, because we have severe supply constraints, skyrocketing construction costs, which we will definitely dig into a bit later, and a guest demographic that is just becoming increasingly demanding about exactly what they get for their money.
It's the squeeze. You have costs pushing from one side and guest expectations pushing from the other. And today we are going to explore exactly how that squeeze is playing out across the board, starting with some major developments in Australia's big capitals, moving through to aggressive acquisition strategies in Queensland, and then finishing up with the tech that might actually save your labor budget.
Let's kick things off down in Melbourne. So we have news from Accor regarding the Mercure Melbourne La Trobe Street.
Right, this is the development at 492 La Trobe Street. They've announced their final construction phase with the doors scheduled to open this coming March.
Yeah.
Now, on paper, if you just glance at the specs, it looks pretty standard. You've got 166 rooms, a restaurant, a gym. But the messaging around this opening is actually quite specific.
It is. They are leaning really heavily on this phrase, quality over speed. Now, usually when a developer says quality over speed, it's basically code for we're behind schedule and over budget.
Yeah, exactly.
But in this context, I think it signals something entirely different. You really have to look at where this project sits. It's right near Marvel Stadium and Southern Cross Station. I mean, that is prime real estate.
Oh, it's the ultimate bleisure location. You have the corporate crowd coming in from the airport via the Skybus at Southern Cross, right? They need a place to crash before a meeting.
Right.
And then you have the huge footy crowds for Marvel. It's a very high traffic, high turnover zone.
Exactly. But because the location is so strong,
Yeah.
historically, developers might have just thrown up a, cookie cutter box and filled it because the demand is practically built in.
Right. They wouldn't have tried very hard.
The fact that they are emphasizing the finish, the 6 premium suites, and the overall design integrity suggests they know the market is completely saturated with good enough. To compete in 2026, even in a prime spot like La Trobe Street, you have to offer a clearly superior product.
It completely mirrors what we're seeing in the Colliers trend data, which we're unpacking later. In a high-cost environment, you just can't compete on price alone because your margins are already razor thin, so you have to compete on product differentiation.
And for the Mercure, that differentiation is considered design in a transit hub. It's making the whole transit experience feel less like transit and more like a proper arrival.
Moving up the coast to Sydney, we see this flight to quality playing out on a much, much larger scale. The InterContinental Sydney has just finalized a massive renovation.
And calling it a renovation honestly feels like a total understatement. We are talking about an AU $120 million investment.
That is a staggering capital injection. Area GM Jennifer Brown led this, and frankly, at that price point, you aren't just replacing carpets and putting in faster Wi-Fi. You are fundamentally repositioning the entire asset. You are changing the soul of the building.
They've structured this new identity around 4 core brand pillars. They are incredible occasions, insider expertise, inclusivity, and flexible dining. Now, I know marketing terms can be fluffy. We all know that.
Sure.
But inclusivity and social anchor really stood out to me as a tangible shift in strategy here.
It's a very deliberate pivot. Think about the history of the Grand Hotel in a city like Sydney. Historically, a place like the InterContinental was almost like a fortress.
Oh, very exclusive.
Very exclusive. It was separate from the city itself. You went in there to escape Sydney. But the social anchor concept flips that entirely. They want the hotel to be the living room of the city, not just a place for wealthy tourists to sleep.
It feels like a completely necessary evolution for the Australian luxury landscape. I mean, we've seen this in Singapore and Hong Kong for years, where the locals actually hang out in the hotel lobbies and restaurants for their business meetings, or just for coffee. Sydney has definitely lagged behind in that kind of cultural immersion.
It really has. And with competition heating up from all these new entrants, we've seen the Capella arrive, we've seen the W enter the market, the InterContinental just had to modernize.
Right.
Flexible dining and insider expertise are really about competing with the local restaurant scene and those local concierge services. If they didn't spend the $120 million, they seriously risked becoming a heritage option rather than a luxury option.
And in this particular market, heritage without relevance just means old.
Exactly. So Sydney and Melbourne are polishing their diamonds, but Brisbane is out there building whole new mines. We have TFE Hotels announcing the Adina Chermside is set to open mid to late April 2026.
This is a 108-key property designed by WMK Architecture. But if you ignore the architecture for just a second and look at the map, this is in Brisbane's northern corridor. It is nowhere near the CBD.
No, it's right next to the Prince Charles Hospital.
That is the crucial detail. This is the urban satellite strategy in action. We are seeing a distinct move away from pure reliance on the corporate traveler in the city center. By planting a flag right next to a major health precinct, TFE is tapping into recession-proof demand.
Visiting specialists, patients' families, medical conferences, that kind of demand doesn't suddenly drop off just because the stock market has a bad week.
Correct. But there is a secondary play happening here, and it's basically the elephant in the room for Queensland right now, the 2032 Olympics.
We're still 6 years out from that, though. Is it too early to call it an Olympic play?
Not at all. The infrastructure buildup is happening right now. The Olympics isn't just a 2-week sporting event, it's a 10-year construction boom.
Right, that makes sense.
There is going to be a massive influx of project managers, engineers, consultants, and construction teams who desperately need long-stay accommodation. And they do not want to be in the CBD dealing with traffic. They want to be out in these satellite hubs near the actual work sites. Adina is perfectly positioned to capture that extended stay market.
It's really smart diversification. And speaking of capturing the Brisbane boom, CLLIX Apartments and Hotels is certainly not slowing down. They've just integrated 2 more assets into their portfolio, CLLIX Brisbane Central and Spire Residences.
Which brings their portfolio up to 13 properties in Brisbane alone. Shankar Kotha, their head of commercial, is running an incredibly aggressive acquisition strategy right now.
It feels a lot like a land grab.
It is absolutely a land grab. They are consolidating all this inventory near Queen's Wharf. They know perfectly well that high-yield demand is outpacing supply in Brisbane. If you can control the inventory before the Olympic squeeze really hits, you have incredible pricing power down the line.
So TFE is playing the long game out in the suburbs, and CLIX is fortifying the city center. Queensland is definitely the chessboard to watch right now. Everyone is just positioning their pieces before the game really heats up.
Absolutely. Now, let's zoom out for a minute and head over to Western Australia. We have a new signing that validates a very different kind of business model. IHG has signed a franchise agreement with the SKS Group for a Holiday Inn Express out in Cockburn.
This is a 170-key build scheduled to open in September 2026. And again, for anyone not totally familiar with WA geography, Cockburn is definitely not the Perth CBD.
No, it's a highly localized hub, but you have to look at the demand drivers there. You've got the Australian Marine Complex and the Murdoch Medical Precinct.
There's that medical theme popping up again. It seems to be the golden thread for safe investments right now.
It's consistent because it works. But the choice of a Holiday Inn Express brand is really significant here. This is the essential model. Limited service, high efficiency, much lower build cost.
Which makes total sense. If you are serving a marine complex or a hospital, your guest isn't there for a lavish resort experience. They're there to work or deal with family. They want a good shower, a comfortable bed, fast Wi-Fi, and a free breakfast they can literally grab on the way out the door.
And from an investor perspective, in this case, SKS Group and their CFO, Eugene Lim, the essential model, is a brilliant hedge against those rising operational costs we mentioned earlier. Fewer staff, simpler operations, much higher margins. It validates that you simply don't need to be in a capital city center to drive strong occupancy as long as you are next to an economic engine.
It's about utility, not vanity.
Exactly. Moving offshore for a moment, IHG is also making some big moves in Thailand. They've signed the Hotel Indigo Phuket Nayang Beach.
This is more of a future play, right? Opening in 2030, it's a 170-key luxury lifestyle property done in partnership with AssetWise.
Yeah, 2030 does seem like a lifetime away in this industry. A lot can change in 4 years.
It does, but it aligns perfectly with IHG's broader goal to double their Thai estate to over 80 hotels. This is what we call the luxury pivot in Southeast Asia.
Right.
For a very long time, Phuket was really about mass market volume. Pack them in, stack them high. Hotel Indigo is completely different. It's a boutique, neighborhood-centric brand.
It tells the local story.
Exactly. It signals that IHG strongly believes the future of Thai tourism isn't just getting more bodies on beaches. It's about attracting higher-yielding, culturally curious travelers who actively seek out that boutique experience. It's a major vote of confidence in the long-term recovery of the region, specifically in the high-value segment.
So we've covered the where and the what quite a bit today. I want to shift and talk about the how.
Yes.
Specifically, how are these hotels actually connecting with their target markets? Because there was a story out of Tasmania this week that I just thought was brilliant.
Are you talking about the Adina and Hockey Australia partnership?
Yes, that's the one. TFE Hotels is launching a new 48-key Adina down in Hobart later this year. But months before even opening, they hosted a community clinic with Hockey Australia.
This is textbook community-first marketing. Usually a hotel launches, they cut a ribbon, they blast out a press release, and they just sort of hope the locals like them. Adina is flipping that script entirely.
By leveraging their national partnership with Hockey Australia, they brought a beloved sport straight to the local community, well before they asked anyone for a single booking.
It anchors the brand so well. It basically says, we aren't just a big building taking up space, we are an active supporter of your kids' sport.
And in a regional market like Hobart, that kind of goodwill is actual currency. You simply cannot buy that kind of deep engagement with a targeted Facebook ad. It shows that TFE understands that to succeed in a smaller market, you really have to become part of the social fabric, not just an observer. It creates this sense of genuine ownership among the locals before the doors even open.
No, we've touched on it a few times already, but we need to officially address the elephant in the room for our deep dive today. The raw cost of doing business right now. We have a new report from Colliers regarding supply growth, and the numbers are, well, sobering is the word you used earlier, and it fits perfectly.
It's really the only word for it. Listen to this stat from the report. Supply growth in Australia is forecasted to be only 1.3% in 2025.
Wow.
That represents just 2,339 new rooms nationwide.
That is incredibly low. For a country the size of Australia with the kind of robust tourism demand we generally have, 1.3% is effectively stagnant. It's basically just the replacement rate.
It is. And the culprit behind this is crystal clear: construction costs. The report highlights that the cost to build a standard upscale project in Sydney has now actually exceeded $830,000 per room.
Wait, let me just wrap my head around that for a second. Nearly $1 million per key.
Yes. Before you even open the front doors, before you hire a single staff member or buy a single coffee bean for the restaurant.
That completely changes the entire feasibility equation for developers.
It acts as a massive handbrake on supply. Developers simply cannot make the numbers stack up on paper. To justify an $830,000 per key build cost, you need average daily rates that the market might not be quite ready to pay yet.
Right.
This is exactly why we are seeing a sudden pause in cranes on the skyline. The boom of new builds in the CBD is likely paused all the way through to 2028. We are seeing major completions like Queen's Wharf and on Hotel Melbourne finishing up their projects now, but the pipeline directly behind them is totally drying up.
But there's a fascinating flip side to this, right? If I'm sitting on an existing hotel in Sydney or Melbourne today, I must be smiling ear to ear reading this report.
You should be absolutely thrilled. This is the replacement cost theory in action. If it costs your competitor $830,000 a room to build a new place down the street, your existing asset, even if it's a bit older, suddenly becomes so much more valuable. You have this massive barrier to entry protecting your market share.
Which perfectly explains why the InterContinental just spent $120 million on their renovation. It is just far cheaper to fix what you already have than to try and build something new from scratch.
Precisely. We are going to see a huge shift where development capital actively moves away from new builds in the CBD and pivots toward renovations, or toward those decentralized lower-cost areas like the Adina in Chermside or the Holiday Inn Express down in Cockburn. The math just works so much better out there.
It's a fascinating market dynamic. The handbrake on supply actually protects the value of the current owners. Speaking of owners who are doing things right, Choice Hotels International Asia Pac just announced their 2025 Gold Award winners.
Yes, CEO Trent Frazier announced that 31 properties made the list this year, including places like the Castlereagh Boutique Hotel in Sydney and the Boca Beach Apartments up in Queensland.
Now, awards are nice. Obviously, everyone likes a shiny trophy on the shelf. But why should the listener care about a franchise award ceremony?
Because of the criteria they use. These awards aren't just about who has the nicest lobby or the fanciest pool. They are heavily, heavily weighted on likelihood to recommend scores, the LTR.
Ah, guest sentiment.
Exactly. In this post-pandemic world, LTR isn't just some fluffy vanity metric. It is a highly accurate leading indicator of financial performance. If you are a franchise operating in a regional area, your entire business model relies on word of mouth and repeat business. You simply don't have the massive global marketing budget of a giant corporation.
So a high LTR score literally translates to tangible asset value.
It really does. If your guests aren't actively recommending you, your franchise value drops, period. Choice Hotels highlighting this just reinforces that in a franchise model, brand health is strictly local. It's not about the famous logo on the door. It's about whether that specific franchisee is delivering an experience that warrants a return visit. It's a great reminder that hospitality is still, at its core, a people business, no matter how big the brand above the door is.
Let's shift gears to our Stars in Motion segment. It's always good to track who is moving where, because talent movement often predicts larger strategy shifts within these companies.
Absolutely. We have some significant appointments to cover this week. First up, Stephen Moore has officially taken on the role of Chief Operating Officer at Lancemore Hotel Group.
That's a really big move. Lancemore is well known for that boutique, very high-touch quality. Bringing in a new COO of his caliber suggests they're gearing up for serious operational scaling or perhaps refining their service delivery even further. It's definitely a strategic play.
Agreed. Then, heading up north, Dean Zahner is the new GM at Oaks Eland Hotel Darwin. Darwin is a really unique market. It's very seasonal and very corporate heavy. It really needs a steady hand at the wheel.
We also have Martin Litkey stepping in as operations manager at Pepper's Retreats, Resorts, and Hotels. And Syed Omar has just started as front office manager at the Ritz-Carlton.
I always love seeing those operational moves highlighted. The front office manager at a Ritz-Carlton is arguably one of the toughest, most demanding jobs in all of hospitality. You are the front line for those incredible occasions we talked about earlier. You are the literal face of the brand. Huge congratulations to everyone on their new roles this week.
Finally, I want to close out with our Tech Muse segment. We've talked a lot about construction costs. We've talked about the critical need for high-quality service. But how do you actually deliver that incredible service without completely blowing up your labor budget? This week, our deep dive focuses on the integration gap and dashboard fatigue.
This is the silent killer in hotel operations right now. Over the last 5 years, basically every hotel has aggressively modernized its tech stack. We moved to the cloud, we downloaded the apps, we integrated the SaaS platforms. Now, we have more data than we even know what to do with.
Right, but now the general manager has 15 different tabs open on their browser every morning. They are doing what we call the swivel chair integration, looking at one screen, turning around, and manually typing that data into another screen.
Exactly. You have a dashboard for revenue, you have one for housekeeping, one for guest messaging, another one for reviews. That is the definition of dashboard fatigue. The data is all there, but it's hopelessly fragmented. Staff are overwhelmed by all these charts and graphs, when what they actually need are immediate answers.
So what's the real solution here? Because we obviously can't just go back to pen and clipboards.
The major shift we are seeing, and big players like Accor and Hilton are heavily driving this right now, is moving from mere data collection to generating actionable insights.
What does that actually look like in practice, though? Give me a scenario.
Okay, imagine this. Instead of a front office manager staring at a static report to see who is arriving in the next hour, the system just connects the dots automatically. It pings them and says, Mr. Smith in room 202 typically orders a flat white at 7 a.m. and he just checked in. Send an alert to room service to have it ready.
Oh, wow.
Or housekeeping has just cleared room 305 and the system knows that guest is currently sitting in the lobby waiting. So it automatically sends a text key to their phone immediately.
It completely removes the need for the staff member to go digging through tabs for that information. It pushes the necessary action right to them.
Correct. And bring this all the way back to that Colliers report we discussed. If construction costs are $830,000 a room, you can bet that operational costs are breaking records right now too. Labor is always the biggest line item on any hotel's P&L.
So technology has to stop being just a fancy reporting tool and start being a legitimate labor-saving tool.
In this market, time is quite literally the margin. If your tech stack forces your frontline staff to check 3 different systems just to answer one basic guest question, you are bleeding money. The true differentiator for 2026 isn't having the most data. It's having the data tell your team what to do automatically. It's about hyper-efficiency right at the point of service.
It's the difference between knowing it rained yesterday and knowing you need to put the umbrella stand out right now.
That is the perfect analogy. And for the hotels we discussed today, whether it's the beautifully renovated InterContinental or that highly efficient Holiday Inn expressing their ultimate success, will depend entirely on closing that integration gap. You can build a beautiful $100 million hotel, but if your back end is a tangled mess, the guest experience is going to suffer.
It's been a really packed show today. From the handbrake on supply driving up the value of existing assets to those strategic satellite locations popping up in Brisbane, and of course the absolute necessity of actionable data to keep labor costs down.
It is a complex market out there, but for the smart operator, there are plenty of opportunities to be found. You just have to be willing to look past the scary headline costs and find the hidden strategic value. It leaves you with a thought. If data platforms eventually evolve to the point where AI agents handle all these actionable insights automatically, we might see the integration gap actually eliminate entire layers of middle management. The technology won't just save the labor budget, it might fundamentally rewrite the org chart for these $830,000 a room assets. Something to think about.
That wraps up this week's 5-Star Weekly Briefing. Thanks for tuning in and staying informed with the latest in the hotel industry.
Thanks to Gain for helping industry leaders scale faster and make better-informed business decisions.
Don't forget to check out our 5-Star Conversations podcast, where Brendan Granger from Technology for Hotels sits down with the industry's most influential leaders to uncover their journeys, insights, and the future of hospitality.
Until next time, stay well and stay ahead.
See you next week.